Hello, everyone. Today we will be discussing startup cost. Today we're going to go over why it is important for you to keep up with your financial records during the startup phase of your business. So I'm gonna bring up my notes. I'm gonna go over a few little topics with you, just so we can understand and know like why the benefits of keeping up with your financial records. Because I notice a lot of times with companies, especially in the home care industry, once you start, once you're in the startup phase of your company, and meaning you're going to get your formation, you're forming your business, are if you are you are I'm sorry, you're sending in your documents for to form your LLC. You may rent a property, then you have to go buy equipment to furnish that property. For instance, you may have to go buy dietary supplies, meaning food and, things like that for your business. You may have to go buy medical equipment for your business. So basically, what I'm going to go over with today is because you're purchasing all of these items before you actually receive your first client. So, how do you account for those expenses from the beginning or when you first start out? So that is what I will be going over with you all today. So first, let me introduce myself. My name is Chavis. I'm a financial strategist that helps home care industry owners organize their books and and help them increase revenue by 25% or more with organized financial strategies. Okay, so that's a little bit about me. Let's get into what we're going to go over today. So, first thing I want to go over is how this benefits you during tax time, your tax deductions, and when you can actually use these expenses for your tax purposes. So, if during the startup phase, if your doors are not ready to open, if you are not ready to serve your first client, then you cannot deduct any of those expenses just yet. But still keep up with your expenses, keep up with your financial records, get your accounting software, get some kind of process in place so that you can always have this information available. So when you do open your doors, when you are ready to launch or when you do launch your business, you can account for these expenses. So once you open your doors, the IRS allows you to deduct up to 15,000 of those expenses that you've incurred during your startup phase. Now I know you're saying that 5,000, where I spent probably 15 to 20,000 opening up my doors, but you can still amortize the rest of those expenses, which is still good. And I'm gonna tell you why. During the startup phase, even though you're spending all of, you may have spent 15 to 20,000 to open up your doors, but have you received any revenue yet? How much revenue do you expect to receive in that first year that you open up your doors? I pray that you know, you're able to bring in 100,000 plus in your business during your first year of business. But the reality is, statistics say that the first 5 years of operating, you operate at a loss. So that's why a lot of businesses fall in the first 5 years. So, in order to help you with this, um, during your financial records, you don't want to expense all of you use all of your expenses in that first year, because that will cause you to have a, a high loss in your business. So you don't want to have a loss of, a lot, like a 10 for instance, if you did 15,000 to 20,000 of revenue, um, then you bring in, I'm sorry, you have expenses like during your startup phase. I take that back. Okay, during your start, yes, I said that correctly. I'm sorry. During your startup phase, you had like 15 or 20,000 of expenses, but your revenue was only 5,000. So then, if you did the 20,000 of revenue, I mean 20,000 of expenses, then you have a loss of 15,000. You put that on your financial on your tax return, and then you turn around and want some finances, get financing or get something done. The first thing that they're going to ask for if you go get a loan is they're going to ask for your profit and loss statement. They're going to ask for your balance sheet. Then they're going to ask for your tax return. And normally it's in that order because I have clients come to me, hey, I need my profit and loss statement. I'm trying to purchase a home. Okay, I give them their profit and loss statement, their income statement. Then turn around because I already know that they're going to turn around and come ask me for a balance sheet. So sometimes I just give them everything because I know that it's coming. So then I turn around and give them a balance sheet. And then the next thing that the loan officer wants is what? A tax return. So you don't want your tax return to show up as a loss. You don't want your profit and loss statement to have that large loss on there either. So that's something to think about in your startup phase. Um, I think that's all I wanted to mention about with the tax deductions. Oh, that's where I was going. So the remaining amount, you're able to deduct the 5,000 in the beginning. The remaining amount you can amortize. So basically, you'll be showing a little amount. You can amortize that your balance up to 15 years. So basically, for 15 years, you will have an expense on your profit and loss statement coming out. So instead of showing the full amount in that first year, you'll be able to spread it out and show it over 15 years. I hope that was, I hope if you have any, let me check. I'm not checking to see if I have any questions. I don't see any questions come up just yet. But if you have any questions, just put it in the chat or even if you're looking at the replay, go ahead and put your questions in a comment and then I will answer them later on. So that's the first thing I wanted to go over was the tax deductions. The next is equity. Now, equity is very important. And this is one of the reasons why I recommend keeping up with your financials in the beginning is because of your equity. Your equity shows how healthy your company is. If you want to go ahead and sell your company later on, they're going to be looking at your equity. If you want investors to come and invest in your company, more than likely they're going to be looking at your equity. And your equity lies on your balance sheet. And so, with that being said, the first year of your company, you're investing in your company. So, when you're investing in your company, you want that amount to show up on your equity. So, if you go and purchase equipment, you want to show that if you purchase the equipment with your cash, your money, because your company hasn't generated any revenue yet, so you can't use anything from your company just yet. It's just getting started. So these are things that you're investing. If you opened up a bank account and you decide I'm going to go ahead and put 10,000 in the bank account, so in my business bank account, so that my business bank account can have a balance and I can start using that amount from my business bank account for what other operational expenses you may have. So that's one thing. So if you go ahead and put the 10,000 in your bank account, what is that going to come out of? We're not purchasing anything with that. Where that other amount is going to go is in your equity. So now we show that we've started investing in our company, which is good because later on when you start paying yourself, if you're LLC and you're not an S corp, which a lot of times you're not an S corp when you first start off. So, and then with that being said, as an owner, you're going to start getting owner's draw. So that's how you're going to pay yourself in the beginning as an LLC. Now, later on, when you decide that, okay, I'm making enough profit to where I can become an S Corp, then that is when you're able to put yourself on payroll. And that's when you pay yourself as an owner, that's when it's going to start showing up on your profit and loss statement. But first, it is going to show up on your balance sheet as a balance sheet account. It's not going to show up as an expense, and it will affect your equity when you start taking those owner's draw. So if you invest, like when you invest in your pre-launch phase, the money that you're putting into your company, the assets you're purchasing for your company, if that what you're giving to your company, if you're recognizing that in your equity, when you start taking those owner's draw, your equity can still have a it's going to be a credit balance because that's what equity is, but it's still going to show up as positive. It's going to show up. It's going to be positive on your equity, as your equity. So that's one thing. I hope that if you have any questions about that, let me know. Oh, hi, family dad. Thank you for the comment. I hope it is helpful. I'm helping some business owners today. What else can we go over with this? I did mention the capital, and so that's one thing is that I wanted you to know that you are building up capital as well during your startup phase. So things like your office furniture, your medical equipment, or your software, those can all be on your balance sheet account as a capital asset. So during the startup phase, you're not only building up your equity, but you're also building up your capital assets. So you can start accumulating assets during the startup phase as well. And I did mention about because I wanted to talk about the funding part, and I did mention about the funding, how it can help you. Um, and so I did mention a strategy in there about how keeping up with your financial records early during the startup phase can help you with funding when you need it, because those investors, those loan officers, they're going to be looking at your balance sheet. They're going to be looking at how healthy your company is. They're going to look at if your company have assets. So those are some things to think about. So I hope this information was helpful. Um, and just in conclusion, just want to mention that starting a home care agency is an exciting journey, but managing your finances from the beginning is key to long-term success. By taking advantage of tax deductions, building equity, and maintaining financial discipline, you're laying the groundwork for a sustainable and thriving business. So even before your first client walks through the door, start tracking your expenses, building your assets, and thinking about your agency's financial future. If you found this information helpful, let me know. As I mentioned, leave any comments you may have, any questions you may have, leave them in a comment for me. Um, so we can just keep this conversation going. And as always, don't forget to like, share, and follow for more tips about managing and growing your home care agency. Until next time, take care. And as always, wishing you much success in your business. Thank you.